So Accounting 201, Chapter 1, Learning Objective 1.4. So we're going to use the accounting equation to analyze transactions. And the accounting equation is assets equal liabilities plus equity. We are also on page 13, just in case you want to follow along in your book. So how do you analyze a transaction? A transaction is any event that affects the financial position of the business, and it can be measured with faithful representation. So we first need to determine, is this a transaction? So buying a computer for the office for $2,000 cash is a transaction. Hiring a new employee is not. How do you analyze a transaction? So transactions can be analyzed in 3 different steps. First, you're going to identify the account and the type of account. So you'll identify, okay, this account is cash, and the type of account is asset. Cash is an asset. So if you just wanted an example of that. Second, you're going to decide if each account increases or decreases. So we said the normal balance of an asset is a debit. And we also said cash is an asset. And then we're going to determine if the accounting equation is in balance. Do our assets equal our liabilities plus our equity? If they do not, we did something wrong, because they should always, always, always equal. And the most common thing that we would do in order to throw them off is we accidentally debited instead of crediting, or we accidentally credited instead of debiting. And we'll talk more about that in examples, but just to let you know, that's the most common error that I've seen. So here we have a transaction on page 14. So we are assuming that Sheena Bright contributes $30,000 cash to Smart Touch Learning, which is a corporation. She contributes cash to them in exchange for stock. So she's buying $30,000 cash of stock in Smart Touch Learning. The e-learning business receives the $30,000 cash, and they issue common stock to Sheena Bright. The effect of this transaction on the accounting equation is as follows. So we see for the business received $30,000 cash. So we are going to increase our cash by $30,000. And cash is an asset. So cash is an asset. Our cash increased by $30,000. Well, whatever happens on the left side has to happen on the right side. So we've added $30,000 over here. We have to also add $30,000 over here in order to keep our equation balanced. So our stock that we issued has to show up somewhere, either in our liabilities or our equity, and we know stock is not a liability because the main thing, I guess I would say, is most all liabilities have payable in it, right? We talked about that earlier. So we know it's not going to fall here. So it has to fall within our equity. And since we added $30,000 cash, we're going to add $30,000 equity so that they both balance. But also because this has a normal credit balance. This is the debit side of our equation. This is the credit side of our equation. That's supposed to be an R.
So I have a question.
Yes.
So for like land, even though it's an asset, you'll also be paying on it. So would you also put it in assets and liabilities?
Well, unless it's paid for. But let's say you purchase land and you're paying for the land. So the land would be an asset, but then you'd also have a note payable on the land because you'd have a loan on it to pay for it. Yep. So that would fall under your liabilities.
Well, no, like say you pay it off, whatever, but like you still pay property taxes. That's
So the taxes payable would fall under liabilities. Yeah. Yep. So now, what we,
what was it was 30,000.
yes. So cash, and this is on page 14. So we increased assets by 30,000 and we increased our equity by 30,000. Yes, sir.
What if you have a land and the taxes is like 2,000? Will it still be the same 30,000 if the taxes is a liability?
So the taxes would be a payable until you pay it, and then when you pay it, you would take it out of cash because it would be coming out of your cash account to pay it. So then you would reduce your cash and you would reduce your payable by the same amount.
Is it only like that because land, I know like it fluctuates, like the depreciation and like the value will be different.
No, so we'll get into some of that. I don't want to get into too much of it because
Okay.
I don't want to.
I mean, because it wouldn't be the same for every like we're doing transactions, so it wouldn't be the same.
Yeah, I mean it'll different. So depending on what it is that you're looking at with the item, it could affect different types. So like we just talked about, if you have like taxes payable and cash, those are two different accounts, but they would affect each other. And then with land and depreciation, you have a couple other, like you have contra accounts and all sorts of other types of accounts. We'll get into when we get there. I don't want to go slow, baby steps. But I love where y'all are thinking. Like I can really tell that y'all are thinking ahead, and I really appreciate that. And I also appreciate the questions. And I'll answer most of them. Some of them, if I know that it might be getting a little too in depth for what we're talking about right now, then we'll push it off a little bit, just because I don't want to scare anybody either.
Okay.
So we have purchased land for cash. So in this transaction, the business purchases land for an office location. They pay $20,000, and this transaction affects our accounting equation as follows. So here we have, so first we're going to identify the accounts and the account types. So the two accounts that are involved are cash and land, and both of those are assets. So cash is an asset and land is also an asset. So that means that everything that we do is going to show up under our assets on the left. We're not going to do anything to the right side of the equation for this transaction. So then we're going to decide if the account increases or decreases. So we purchase land and we pay cash of $20,000. So is our cash going up by 20,000 or down by 20,000? Down. So cash account is going to go down by 20,000. And since we know both of these are assets, they both fall under assets. If our cash account goes down by 20,000, what does our land do? Our land will go up because we have to keep, these will end up equaling out. They have to equal out. The left has to balance with the right. And so cash is going to go down by 20,000 because we paid out 20,000 in cash. We've received 20,000 in land value. So our land is going to go up by 20,000. That ends up making what? These both cancel each other out. So there ends up being no difference over here, which means nothing is affected over here. Plus, we know nothing's affected over here because we're only looking at these two. Oh, I did it again. We're only looking at these two accounts, and they're both assets. But if these, all the accounts here balance out to zero, we know that nothing is affected on the right. Do y'all have any questions about that? Okay. And so then the third step would be to determine if the equation is in balance, and we have determined that it is in balance because the effect of cash decreasing by 20,000 and the effect of land increasing by 20,000, they both netted to zero, meaning that this accounting equation should still balance, and it does, because 10,000 plus 20,000 equals 30,000, and we have 30,000 in equity on the right. So it does balance, and that means that everything we did was right. And now we can move on to the next, whatever our next step would be, if we had another account to enter. And we do. So we have transaction number 3. So we have purchased office supplies on account. We buy office supplies on account. Does anyone know or want to guess what on account means?
What, with credit?
Yep.
Okay.
Yep. Like credit. So it's basically, and like, so contractors especially, and other people can have this as well, but say you're a contractor and you shop at Home Depot a lot. Well, a lot of times for contractors or people, that shop there often, a lot of times they can open a Home Depot account and they can go in, or they could send their employees in, and the employee could go in and say, hey, I need to get $500 worth of wood, and can you put it on this company account? Or it could be an individual. Can you put it on John Doe's account? And they will go ahead and give them the $500 in wood. They will put the $500, the cost of the wood, on their Home Depot account, and the business owes Home Depot $500. And so now on the business's books, the business would have something, not going to say it yet, showing on their books that they owe this $500 to Home Depot. Yes, ma'am.
Will the business send an invoice?
Well, we'll probably have an invoice on it, but there's an actual account on our books that we're going to put that $500 in. Accounts payable. Is that what you were? Accounts payable.
Oh, okay.
Is that what you, or?
So your accounts payable, that would be under a liability, not an expense, because it's not out of your account yet. It's still something that you have to pay.
Yes, ma'am. It's payable. It is not yet paid. Yes, very good, correct. So Smart Touch. Yes, ma'am.
When you pay it, then it goes to expenses.
Maybe. We'll talk more about that. Depends on it depends on the expense. But it depends on what it is. Well, no, accounts payable would actually go out through cash when you pay it.
Okay.
Sorry, it'll go out through cash. So we have purchased office supplies on account. So we went to Home Depot and we said, oh wow, and they're using $500. Perfect. Good example. So we went to Home Depot, we bought supplies on account, $500. And so Home Depot gave us our stuff, and we're going to put that $500 on our accounts payable account, showing that we owe Home Depot, or in this example, Smart Touch Learning owes $500, and they've placed it in their accounts payable account. And a lot of times when you use on account, you'll have terms. So the terms for this particular transaction is they want to have their money paid within 30 days. So we, Smart Touch Learning, have an accounts payable of $500 that we have to pay within 30 days. It's due within 30 days. So to record that, we are going to, we see here we have our assets and we have our liabilities. Those are the two accounts that are affected. And we purchased office supplies. Office supplies are an asset. So our asset side is going to increase by $500 because we purchased $500 of office supplies. So that asset account goes up by $500. And we purchased it on account, so our accounts payable account will go up by $500. So we've increased our assets and we've increased our liabilities both by $500. So both sides of our equation should balance, and they do. Does that make sense? Do you have any questions? Okay. So now in transaction 4, this is on page 15. So we have earned service revenue by providing training services for clients. The business earns $5,500 in revenue, and we collect this in cash. So we've collected the $5,500 in cash. We've received this cash, so our cash is going up. So our cash increases by $5,500. Cash increases by $5,500. And we performed this service, this is our revenue. So our revenue is also going to go up by the same amount. And our revenue falls in our equity accounts. So our cash went up by $5,500 and our revenue is going up by $5,500. Both sides balance because both sides increased by the same amount of money. Does anyone have any questions on that? Okay. And these are good examples to go back and look through when you're working on your homework, your quiz, your assessment, because these are showing you what accounts are affected and how they affect other accounts. So for example, right here, we have revenue and cash. And then I know that you have I'm pretty sure there's a supply account on the assessment. So if you refer back to this slide, you'll see supplies. In this example, supplies affected the payable. So supplies and payables were affected. So just go back and look at that. Now, it's not always the case, though. I just want to point that out. If they bought supplies with cash, then you would have seen these two accounts affected and nothing would have happened over here if they bought the supplies with cash. So I just want you to note that. But since they bought the supplies on account, we have a payable. So it won't always be a payable and a supply account. It could be cash, it could be another form. So just know that. All right, so then in transaction 5, Smart Touch Learning earns service revenue by we talked about this already. This is talking about.
So what if it doesn't, if it's not balanced? Is that gonna be this one, like it's not balanced?
So it will always balance. If it does not balance, then something somewhere is incorrect. So maybe you added 500 and you were supposed to subtract it, or that's normally the most common difference. And if it happens and it's only in one account, I'm gonna mention this later, but let's just say, let me go back to an easier example. Let's go back to like the start. No, that's not hard enough. We'll just go here. So this 500 and 500. So let's say we got confused and we said, okay, we have office supplies and we have accounts payable, and for some reason, and we weren't looking at it based on the accounting equation. We were just like writing it down. We said, okay, so our office supplies are 500 and our liability and our accounts payable is 500, and we ended up putting a negative 500 for accounts payable. Let's just say we did that. So if we accidentally put negative 500 here, what would this would actually, instead of both sides equaling 0, we subtracted 500 from here instead of adding it, so that's actually a difference of 1,000. It duplicates. So instead of adding 500, we subtracted 500, so it's actually a difference of 1,000. So we'd be off by $1,000. So if you take the amount that you're off by and you divide it by 2, it will give you 500, and then you will know to go look for an account that has a $500 transaction, and that is more than likely probably where your mistake is. You will see something like that when you are working on your assessment. You will probably more than likely run into that somewhere on requirement 2. And so if you do run into somewhere where it does not equal, try that first. Try dividing it by 2, the difference, and see if that gives you a number that is listed over here in your adjustments. Another thing, you'll probably want to, at the bottom, maybe add in like a sum. We're looking at the assessment right now. I'm recording this, so that's why I'm saying that, just in case y'all are watching the video later. We're actually looking at the assessment right now. So you may want to sum up all of your debits, sum up all of your credits, and then just make sure like these two should equal. So if that was 9, why is it 9? If that was 9, if your debits were 9, then your credits should be actually not on adjustments. Sorry, I'm on the wrong column. We know unadjusted doesn't balance because we haven't adjusted it yet. But right here, so after we adjust, we add in all of our adjustments and we adjust everything, our debits and our credits should equal. So if this is 9, then this should be 9. All right, if it's not, find the difference between the two. I'm going to use even numbers because this will be easier. So say that's 20 and that's 10. The difference between the two would be 10, right? And then you would just divide that by 2. And so you'd be looking for something that was a 5. If there's more than one error, the division's probably not going to work, right? Because now we're looking at 2 different errors. But if it's just one error, that's like one of the quickest ways to locate the error. And it could be a typo. It could even be like maybe you typed wrong. Maybe you're missing a 0. I have seen that a lot, where students forget to put an extra 0, like the actual 0 in or something like that. So just keep that in mind. All right, so transaction number 5. So we performed a service for clients who do not pay immediately. The business receives the client's promise to pay. They're promising to pay $3,000 within 1 month. This promise to pay is an account receivable. So the customer is saying, hey, I promise I'll pay you $3,000. So for us, the company, we expect to get $3,000 from this customer. It's going to still go on our books, even though we haven't received the money, because we still have to record it on our books. But we're going to put it on there. Instead of them giving us cash of $3,000, they said, I promise I will pay you $3,000. So that is a receivable, an account receivable.
So what to us is an account receivable, is to them an account payable.
Yep, exactly. And so here we're going to record, so, and because it's money that is owed to us, we expect to receive this money. That is an asset for us. So our asset, accounts receivable, will fall under our assets. So we have increased our accounts receivable account by $3,000. Our assets increased by $3,000. So our revenue is also going to increase by $3,000 because this is service revenue. We performed services. So we're going to increase our service revenue by $3,000. And our assets and equity are both affected. They both balance. And then for transaction 6, so here the business pays $3,200 in cash expenses, $2,000 is for office rent, and $1,200 is for our employees' salaries. So the $3,200 in cash expense, we've paid that out. So we're taking that money out of our cash, out of our pocket, and paying stuff with it. So our cash is going down. So we're going to subtract out $3,200 from our cash account. And that $3,200 is going to then affect the other two accounts, which we said were office rent and employee salaries. And we paid it out. So we're going to reduce our rent expense by $2,000. And we're going to reduce our salaries expense by $1,200. So we're subtracting out $2,000 for rent expense, subtracting out $1,200 for salaries expense. We've subtracted here. Those both equal out to the same amount. So we know that we're still in balance. And then transaction number 7, the business pays $300 to the store from which it purchased office supplies in transaction 3. So in transaction 3, we bought office supplies on account. And now we are paying $300 towards that purchase. So we're going to take $300 out of our cash account. So we're reducing cash by $300. And remember, we bought those supplies on account for $500. So our accounts payable account currently we have a $500 payable, but when we pay $300 towards that, we're going to reduce that payable by the $300. So now our accounts payable is only $200. So we still have a payable, but it's $200. We notice that both the $300 hit our cash account in assets and the $300 hit liabilities, accounts payable. So the accounts, both sides still balance because the same amounts took place on each side. And then transaction 8. So in transaction 5, we performed services for clients on account. So we went ahead and we performed the work and they said they were going to pay us later. So now we're going to collect $2,000 from that particular client. They're paying us $2,000 towards the services that we already rendered that they owe us for. So we're going to record an increase in our asset account for cash. So they paid us $2,000. We're bringing that cash in, $2,000. And they owed us the money, so that affected our accounts receivable. Now they've given us $2,000 towards that, so we're going to subtract that $2,000 out of our accounts receivable. And now they only owe us $1,000. Both transactions took place on our asset side. They both equal out, so we know that our equation is still in balance. And then transaction 9. So we distribute a $5,000 cash dividend to the stockholder, Sheena Bright. So Sheena Bright withdraws, it's supposed to be 5,000. There's missing a zero, see? Typos. So she withdraws 5,000 cash from the business. And so we see here, that means we're giving her 5,000 cash. So our cash goes down by 5,000. And it's a withdrawal, an owner's withdrawal. So our owner's withdrawal, our equity will go down by 5,000. So equity went down by 5,000. Cash went down by 5,000. What slide is that? That is slide 39. All right, so transaction analysis. Let's see, this is 1-5. So this is on. Okay, so this is just showing us all of the transactions that took place. So all of the transactions that we have talked through, this is just showing us everything here. This is also a good reference to go to when you are performing your work. So on page 18, and you'll see, so for example, everything that affected our cash account. So we added 30,000 cash. We paid out 20,000 cash, which left us with $10,000 in our cash account. And then we added in 5,500 in cash, which brought our cash up to 15,500, etc. I'm not going to read through all these, but it's just showing us that these are all the transactions that took place that we just went through, and the end result is both our assets equal our liabilities plus our equity. They both balance. So 30,500, 30,500. This is how you want your assessment to look as well. So your assets should equal your liabilities and your equity. Your debits should equal your credits. Does anyone have any questions on 1-4 right now? Okay. All right, so in 1.5, we're going to prepare financial statements. So how do you prepare financial statements? Financial statement is a report of the business activity. There are several different reports, financial statements that are used. Income statement, statement of owner's equity, balance sheet, statement of cash flows, profit and loss. There's tons of different reports out there, but your main financial statements and the ones that we're going to cover here are income statement, statement of owner's equity, balance sheet, statement of cash flows. And our income statement provides information about our profitability for a particular period. So just remember, period. I mean, don't just remember that, but remember income statement, particular period for the company. And the income statement is prepared by taking the revenues minus the expenses, and then that tells you what your net income or your net loss is. Revenue minus expense equals either your income or your loss. And remember, we talked about if your revenues are greater than your expenses, then you'll have an income, net income. If your expenses are greater than your revenues, then you're going to have a net loss. The statement of owner's equity. This informs users about how much of their earnings were kept and reinvested in the company. It shows the changes in the owner's capital account for a specific period. And we prepare the statement of owner's equity. We take the capital beginning plus the owner contributions, what the owner contributes, plus whatever their net income is, or if it's a net loss, we're going to subtract out the net loss for that period. We're going to subtract any owner withdrawals because the owner took money out. And then that's going to leave us with our ending capital. A balance sheet provides valuable information to financial statement users about economic resources that the company has, such as assets, as well as debits that the company owes, liabilities, and allows decision makers to perform their opinion about the financial position of the company. And we prepare the balance sheet by looking at assets equal liabilities plus owner's equity. And then our statement of cash flows. This reports on a business's cash receipts and cash payments for a period of time. We prepared prepare the statement of cash flows. We take the cash flows from our operating activities, investing activities, and our financing activities. And that is how we prepare our statement of cash flows. You are going to be preparing these in your assessment. So this is slide 42, and we're going to talk more about these. And just keep in mind, how is it prepared? So to prepare the income statement, it's revenues minus expenses equal your net income or your net loss. Statement of owner's equity, this is how this is prepared. Your balance sheet is prepared using this, and your statement of cash flows is used with this. So just note that. Financial statements are business documents that are used to communicate information for decision making. Examples of financial statements are your income statement, statement of owner's equity, balance sheet, statement of cash flows. The income statement reports the net income or net loss of the business for a specific period. So this is on page 20. At the top of your income statement, you always have the business name. So we have the business name, the type of statement that it is or report. In this example, we're looking at the income statement. And then the income statement is for a period. So this income statement is for the month ending for November 30th. So you'll always see the period there as well. And then for the month of November, our revenues, we had one revenue account that was service revenue. Our service revenue account had $8,500 in it. So we received revenues of $8,500. We paid out expenses. We had expenses of rent expense for $2,000 and salaries expense for $1,200. And so I want to also point this out because formatting is a big deal as well. And you're like I said, you're going to be creating one of these in your assessment. Notice where they put the numbers. So for revenue, this amount we only had one account that was affected in revenue, so we just put that to the right. Down here in expenses, we had more than one expense account. So what we do is to the left, you list out each individual expense, and then we're going to total this up to give us the total amount of our expense. So the far right is the total. These are all the totals. So if we had two different revenues, if we had like service revenue and sales revenue, then they would be listed out individually to the left, and then we would total them to the right. Does that make sense? So if you're having to add something together to get a total, it goes to the left. This is just kind of like you're showing your work in a way. But really more so what you're doing is, especially for people that are looking at these statements, they want to see, well, instead of just seeing our total expenses were $3,200, a lot of times they want to know, well, where did that money go? What were the expenses? You know, like they want to know what the total expenses were, but they also want to know, well, what were those individual accounts that were the expense accounts? And so we're going to list out the individual accounts to the left, but we're going to total it up on the right. And the same for revenue. So if we had more than one revenue account, we would list those out individually to the left. And then the statement of owner's equity reports how the owner's capital account balance changed from the beginning to the end of the period. So same thing, we start with the company name at the top of the report, and then what report it is. So it's stating that it is the statement of owner's equity report. This is for the month ended November 30th. And then we see here we've got our retained earnings. We had 0 in retained earnings for this particular period. Our net income for the month was $5,300. Our income statement, if our income statement was wrong, if we doing your assessment, just want to point this out. When you're working on your assessment, if your income statement is inaccurate, if it's not right, see this 5,300. When you go to create your owner's equity account, your owner's equity report, it's also going to be wrong. So because your income statement, your net income or net loss flows to your owner's equity report. So if it's wrong on one report, it's going to be wrong on the other report. So just note that. Now, once we have those two items listed, we can then determine what our, we have our retained earnings of 0, our net income for the month of $5,300. Now we're going to add in or subtract out our dividends. In this case, we paid out $5,000 in dividends. So we're going to subtract out the $5,000 for dividends, and that's going to leave us, it doesn't show it in the book, but so that's going to leave us the $30,300 sitting in our capital account. Oh, it does. It's on the next page. There we go. So the balance sheet, this is page 21. The balance sheet reports all of the assets, liabilities, and equity. And this is as of a specific date. So again, with the balance sheet, all the reports, you start with the company name, then you have whatever the report is. So in this case is the balance sheet. And then this is our balance sheet on November 30th. And so here, this might look a little familiar to you. Assets equal liabilities plus equity. We have all of our assets listed on the left side of the balance sheet. And then our liabilities and our equity are listed on the right side of the balance sheet. And each asset account is listed separately, and then the total is listed at the bottom for all of our assets. So every asset account we list out: cash, accounts receivable, supplies, land. We list out whatever the balance is in those accounts. Then we're going to add that up to get our total assets. And then for liabilities, we're going to list out our liability accounts. We're going to list out our equity accounts. Now, if we had multiple liability accounts, in this example, we only have accounts payable. But if we had multiple liability accounts, we would show it similar to this, where we would say accounts payable, notes payable. And then we would have a total liabilities. We would add those together and put whatever the total liabilities were. In this example, we only have one account, so that's why that's not shown. But you will have multiple liabilities in your assessment. And so to list those out, you would just you would just add like, I'm just gonna put NP for notes payable, because I can't write with a mouse very well. So we'll say we have an accounts payable and we have a notes payable, and notes payable is, I'm just gonna say 10 because like I said, I can't write very well with this. So you have accounts payable and notes payable of $10 and $200. The total of the two would be 210, right? So you'd put 210 here. I'm just going to do a line, and you would write total liabilities here. So you'd have total liabilities, and they equal $210. And then you would show your equity account. And the same for equity. If you had multiple accounts flowing under equity, you would just list those out there. And then at the very bottom, you would put your total liabilities and owner's equity. You'd add the liabilities plus the owner's equity balances, and that would give you the total balance. This total liability and owner equity amount has to equal your total asset amount. If they don't, something somewhere is wrong, right? And so we need to go back and find it. And note here, your retained earnings is taken directly from your statement of retained earnings. Statement of cash flows. Same thing with your report information at the top. This is for the month ended November 30th. And so here we see our statement of cash flows. We've got the cash flows from operating activities. And then we have operating activities. We have financing activities. And we have investing activities. So those are the three activities that we list. And then, so from our operating activities, we collected money from customers. We paid rent, we paid salaries, we paid office supplies. And same thing that I mentioned earlier about if you have one single account that's affected. So in this example, our receipts, we only had one account listed under receipts that was affected, and it was the collection from customers account. So we're just going to put the total on the far right because it was only one account affected. However, in payments, we made payments for rent, salaries, and office supplies. So we're going to list those payment accounts out individually to show, well, we paid, well, of our payments, 2,000 of it went to rent, 1,200 went to salaries, 300 went to office supplies. So we've listed those individual accounts out. We're going to add those up. So we've added these up and we said, okay, we have $3,500 in payments total. So you're going to write that $3,500 in payments total right here to the far right because that's the total payment amount. It was negative because they're payments, they're going out. So we put that in as a negative, and we're going to subtract that from the receipts that we received, the money that we received of $7,500. And so our net cash provided by operating activities was $4,000. And then when we look at investing activities, same thing. You'll do the same thing. So we have land, and then there was only one account affected, so 20,000 land, 20,000. Cash flows from financing activities, we have an owner contribution. The owner contributed 30,000, so that went in. And then the owner took out 5,000, so that came out. The difference of 30,000 minus 5,000 is 25,000. So the net cash provided by financing activities is 25,000. And so our net increase in cash is $9,000. The balance at the beginning of November, we started with 0. So we had 0 at the beginning of November. And then the balance at the end of November, we see here is 9,000. So the ending cash balance is 9,000. Does anybody have any questions on 1.5? I would use that, like all of those examples, when doing your assessment, because it's just, I just feel like it's easier to look at it and to see how it was done, and then apply it to what you're doing. But it's up to you. What works best for you. So, all right. So we're gonna go ahead and jump into 1.6. So use financial statements and return on assets to evaluate business performance. How do you use financial statements to evaluate business performance? Return on assets measures how profitably a company uses its assets. Return on assets is calculated by dividing net income by your average total assets. So this is a good place to refer to the formulas. So we have, write these down or something, slide 49. But return on assets equals our net income divided by our average total assets. And then to find your average total assets, you need to take the beginning total assets plus the ending total assets, and then divide that by 2. And that will give you your average total assets. So you kind of need to know this equation in order to be able to complete that one. So just note both of those. And that is it. So does anyone have any questions so far? No? I do have some practice questions for us to do. Oh wait, hold on, no, not that. I wanted to. Oh wait, hold on, no, not that. I wanted